Welcome to The Explainer. Today, we're diving into a technical analysis report for the stock KVU. And this one is interesting. We're going to see how one huge day on the market can spark this incredible battle, this tug of war for control. It's all about turning a bunch of data into a real story.
So this is really the big question, right? After this massive, out-of-nowhere surge, what's really going on? Is this the beginning of an amazing comeback story? Or is it a classic bull trap, just waiting to snap on anyone who gets too optimistic? We're going to dig into the evidence for both sides of that argument.
Okay, so check this out. On November 3rd, KVUE didn't just, go up a little bit. It absolutely exploded. We're talking over 12% in one day. And here's the real kicker. The trading volume was more than 10 times the daily average. When you see a move that big on that much volume, it's like a giant signal flare shooting up. You just have to pay attention. In that one day, that one event sets the stage perfectly for this classic market showdown. You've got two camps. In one corner, you have the bulls, right? The optimists. They're looking at this surge and thinking, this is it. This is the start of a brand new rally. But in the other corner, you've got the bears. They're the skeptics. They're looking at the stock's history and saying, hold on, this is just a blip. The long-term trend is still down.
All right, so let's start with the optimists. Let's build the case for the bulls. The report lays out some pretty compelling data points that suggest this big upward move, well, it's not just random noise. It looks like it's got some real substance, some real power behind it.
So the whole bull case really comes down to three key things, three pillars. First, the data is showing a new trend is forming, and it's a strong one. Second, that upward push, that momentum, it's actually getting faster. And third, that crazy volume we saw, that's a huge clue that the big money, the large institutions, are starting to jump in.
Okay, let's talk about that first pillar, trend strength. What's super interesting here is this ADX score. Now this indicator basically just tells you how strong a trend is. Up or down, doesn't matter. Anything over 25 is pretty serious. KVUE's is at 47. The report calls that a very strong trend. So right away we know this isn't some weak, random bounce. And if you look just below that, you can see the bulls line, the plus DI, is way above the bears line. It's not even close. That tells you exactly who's in the driver's seat right now.
All right, pillar number 2, momentum. And this is where it gets really good for the bulls. See, it's not just that the price went up, it's about how it went up. The MACD, which is a go-to indicator for momentum, just flashed a big buy signal with a bullish crossover. But check this out. This is the important part. The MACD momentum is positive. That means the upward force isn't just there, it's actually accelerating. The trend isn't just strong, it's getting stronger by the day.
But that's only half the story, right? As good as all that sounds for the bulls, the report is very clear. We cannot ignore the history here. There are some serious headwinds this stock is flying into. For every single one of those bullish signals, there's a bearish fact pushing right back at it. So now we have to look at the other side of the coin.
And this slide right here, this is the whole conflict in a nutshell. It's like a tale of two charts. If you zoom in and just look at the last few days or weeks, everything is fantastic. The price is way above its short-term averages. But when you zoom out and look at the bigger picture, you see the problem. The stock is still way, way below its key long-term averages, especially that 200-day moving average. For a lot of investors, that is the line in the sand, and being more than 23% below it, that screams long-term weakness.
Yeah, and the report doesn't pull any punches about it either. It uses this really stark phrase, calling it a structural bearish situation. Now, when you're a long-term investor, hearing the word structural is a huge red flag. It means the problem isn't just temporary, it's built into the stock's long-term trend. So despite all the recent fireworks, the underlying foundation is still looking pretty shaky. And the list of worries for the bears keeps going. The report also flags that the price might have just moved too far, too fast. It's what traders call overextended. Think of it like a rubber band that's been stretched too far. It's at high risk of snapping back. On top of that, there's an indicator called on-balance volume. It's kind of like keeping score between buyers and sellers over time. And that score is still negative. It shows that, big picture, the sellers have still been winning the war. So what do? You've got this powerful, short-term bullish charge running headfirst into this massive, long-term bearish wall. The signals are completely conflicting. So what's the plan? Well, the report takes all this data and boils it down to a very specific, very actionable strategy. And here it is. This is the playbook. Now notice, this is not a long-term investment plan.
It's a short-term, swing trade designed to last just 1 to 5 days, and it's super precise. It says, go long, meaning buy, around 1614. Your target to take profits is 1683, and this is the most important part, your stop loss is at 1579. That stop loss is your safety net. It's what keeps a small mistake from turning into a disaster if this thing goes south.
Of course, any good plan is all about managing risk, right? And the report points out 3 big ones. First, some indicators are screaming that the stock is overbought, which basically means it's due for a cool down. Second, remember, it's still stuck under those huge long-term averages. And third, this stock is just plain volatile. It swings around a lot. So how do you deal with that? The advice is simple. Use those tight stop losses we just talked about, and maybe trade with a smaller amount of money than usual to handle those wild swings.
Okay, so we've weighed all the evidence. We've seen the incredible short-term momentum, and we've seen the pretty scary long-term history. So what's the bottom line? What's the final verdict from the analysis?
And this is really the key takeaway. The verdict is completely split, and it all depends on your timeline. For the next 1 to 3 days, the report gives it a strong buy. It says to ride that powerful momentum. But if you look out over the next 1 to 3 months, the rating drops all the way to neutral. Basically, it's saying, let's just wait and see. We need more proof that this rally can actually break through that bigger bearish wall.
This quote pretty much sums up the entire report. Yes, this is a high-conviction, short-term rebound. There's a real opportunity here for a quick trade. But, and this is the part you can't forget, that big structural downtrend is still there. It hasn't gone away. And that's why the final piece of advice is so important. Whatever you do, trade with discipline.
So in the end, the report gives us all the data, the context, and a really clear strategy. But it leaves us right here, with this one massive question. The battle lines have been drawn. The bulls and the bears are in a standoff. So what happens next? Will this incredible burst of momentum be enough to change the story? Or will the sheer weight of that long-term trend just drag it right back down? Well, only the market can answer that.